Obviously, very good news with the vaccine, 90% efficacy. It's very promising, not just for markets, but I guess humanity in general. So keep in mind, though, it is early stage. It is a very small sample. There's still very big question marks about how it's going to be distributed. We know it's going to be stored at negative 70 degrees. How it's going to be produced, obviously we don't produce RNA viruses in Australia, how it's going to be distributed, and also the safety issues. So there's still a few things to go yet, but certainly the 90% is very encouraging. And we also look forward, just this chart here, which you can see, we're looking forward to a slew of other results out from a couple of other potential candidates. So we've got Moderna's coming out over the next few weeks, AstraZeneca as well as J&J. Moderna's is very similar to the technology that Pfizer's is. It's RNA virus, so we're expecting very similar results. Obviously, we haven't heard any safety concerns from that one as well, so certainly looking for some really positive results there. So the market could very well continue to rally on the back of positive results, and you'd notice the timeline there. It's showing it's imminent in the next few weeks. But we do need to be careful not to extrapolate it too much at this stage. As Tom pointed out on Tuesday, we saw 40% of global fund managers say that they are expecting a vaccine or a vaccine candidate to be announced in Q1 next year. So perhaps that may be brought forward a few months earlier. But what this chart shows you, it's actually from the Good Judgment Project. And it's a collection of experts or geopolitical forecasters. They call it the super forecasters. And what the expectation is for a vaccine to not only be announced, but also be rolled out in quantity to the US. And you can see there that what they're expecting, the bulk of them are expecting a vaccine to not only be announced, but released by May next year. So that's to the tune of 25 million vials. So look, it means that, I guess, a lot of that has been priced in. There is an expectation that some of that, the vaccines will potentially come in a lot earlier than what the market, was expected. And looking across our market, it's clear that the vaccine and the reopening trade is already priced into many of our sectors. If you look on the left-hand side, what sectors are expected to return back to FY19 earnings this year or even earlier, you can see there's a slew of them. So I think where the opportunities are is on the right-hand side of the equation. So I don't think, the vaccine being announced is going to do a whole lot to aggregate earnings, but where it might actually bring some earnings forward is where we see, sectors that are expected to come back in FY23 and beyond. So no doubt some of the sectors that we're going to be talking about this morning at the epicentre of COVID-19. So what we do expect to see is what we saw this week, where there's a bit of rotation. So we see it more as a rebalancing event rather than anything fundamental. We do think, some of the froth that's has come out, particularly around that high PE segment of the market. The chart on the left-hand side shows you, that's the PE dispersion chart that we like to show. And since COVID-19 hit in March, PE dispersion has just exploded even further to the tune of about 6 PE points. So we do think some of that top end of the market will rebalance into that bottom end. Some of the laggards on the right-hand side, which is in the circle there. So some of the risk premium in those sectors like coal, media, travel, those sectors may continue to catch a bid if we do see some good news out of the vaccine. But we don't think it's wholesale rotation out of growth into value. If you look at sort of what's happening in the global macro, we still are in a very low growth environment. COVID-19 still not under control in Europe and in parts of the US. We've heard today, the New York is in a partial lockdown once again. Obviously, a Biden White House is very different to a Trump White House, and also, not having both the House and the Senate getting any meaningful policy to stimulate the US economy is somewhat limited. So in terms of actually generating growth and stimulating the US economy out of the COVID-19 recession is going to be somewhat limited. So we do think, that growth trade is not done yet. However, you do see some of that froth come out in the top end. So before I hand it over to the analysts just to talk through the sectors, I guess we need to talk about some of the potential funding sources and where we think some of the opportunities are to rebalance your portfolios. And I'll just point you to Joe Little's note out a couple of days ago, just looking at the retail sector, running through the implications of the vaccine on her sector. She's always called that out as a potential risk. She's downgraded Accent, Baby Bunting, Beacon Lighting Motors and Super Retail Group back to a hold. But she does note that the upcoming Universal Store as well as Lovisa are reopening trade, so there are potentially some opportunities there. They are beneficiaries of reopening. Also, some of the online media names, REA, Seek and Domain, are well above Anthony Porto's valuations. They have had a tremendous run recently. So potentially some of those names may continue to feel a bit of pressure, at least in the short term. Also, we've trimmed NextDC and Rio Tinto in the model portfolios, which Hatch will talk to today. So obviously, they, some of the high PE names, Iron Ore has done well, also NextDC. So we have taken a bit off some of those names. In transport infrastructure, it is Transurban, which is sitting about 10% above Nathan's price target, so certainly more than priced in a recovery there. And finally, healthcare, also in the model portfolio, we have trimmed Sonic Healthcare as well. Just seeing it's had a tremendous run, benefit from the testing environment right through COVID, so see it as an opportunity to trim that name, just given its very strong run.